Welcome to Money Mode, the channel that makes money talk less confusing and way more useful. Let's get into it. Every time this number ticks up or down, global markets pay close attention. It is not a stock price, not a company earnings report, and not a headline about a CEO. It is the yield on a bond, and many analysts consider it one of the most important numbers in all of finance. Today we are breaking down what bond yield actually means, why it moves the way it does, and why stock market investors, central banks, and even everyday borrowers are watching it so closely. Let's start with the basics. A bond is essentially a loan. When a government or a company needs money, it can issue a bond instead of going to a bank. Investors who buy that bond are lending their money, and in exchange, they expect to be paid back with interest over time. That interest, expressed as a percentage of the bond's price, is what we call the yield. Here is where it gets interesting. Bond yield and bond price move in opposite directions. When demand for a bond goes up, its price rises, but the yield falls because the fixed interest payment becomes a smaller percentage of a higher price. When demand falls and the price drops, the yield rises because that same interest payment now represents a larger percentage of a lower price. This inverse relationship is the engine behind almost everything that happens in the bond market. So what makes demand for bonds rise or fall? Several forces are constantly at play. Inflation expectations are one of the biggest. If investors believe prices will rise quickly in the future, they demand higher yields to compensate for the shrinking value of their future interest payments. Central bank policy is another major driver. When a central bank raises interest rates to fight inflation, newly issued bonds offer higher yields, which pulls yields on existing bonds upward as well. Economic uncertainty also plays a role. During times of fear or crisis, investors often rush towards safer assets like government bonds, pushing their prices up and yields down, a pattern often called a flight to safety. Among all bonds, one number gets more attention than any other: the yield on the 10-year government bond, especially the United States 10-year Treasury. It is often treated as a benchmark for the entire financial system. Mortgage rates, corporate borrowing costs, and even the pricing of stocks are all influenced by where this yield sits. This brings us to the yield curve, which simply plots yields across different bond maturities, from short-term to long-term. Under normal conditions, longer-term bonds offer higher yields, since lenders want more compensation for tying up their money for a longer period. But sometimes, the curve inverts, meaning short-term yields rise above long-term yields. Historically, an inverted yield curve has often appeared before economic recessions, which is why economists and investors treat it as a warning signal worth watching closely. Now, why does the stock market care so much about bond yields? The answer lies in how investors value future profits. Many stock valuations, especially for growth companies, are based on projected earnings far into the future. Higher bond yields increase the discount rate used to calculate the present value of those future earnings, which can make growth stocks look less attractive. On top of that, when bond yields rise significantly, some investors shift money out of stocks and into bonds, chasing a safer and now more competitive return. This is why a sudden jump in yields can trigger sharp reactions across equity markets, even when nothing has changed about the companies themselves. Rising yields also ripple into everyday life. Higher yields tend to push up mortgage rates, auto loan rates, and the cost of business borrowing. That can slow down spending and investment across the entire economy, which is exactly why central banks use interest rates, and by extension bond yields, as one of their primary tools to manage economic growth and inflation. Understanding bond yield gives you a window into how the entire financial system is thinking. It reflects expectations about inflation, growth, risk, and policy, all compressed into a single moving number. The next time you hear a headline about yields spiking or falling, you will know it is not just a technical detail for bond traders. It is a signal that ripples through mortgages, stock prices, and the broader economy. This video is for educational purposes only and is not financial advice. Always do your own research or speak with a licensed financial professional before making investment decisions. If this explanation helped make bond yields click for you, follow the channel for more clear visual breakdowns of the financial concepts that shape our world.